Chris, can you hear us?
I think he dropped.
Yes. I'm looking at his screen, but I don't hear him. All right.
How's everyone doing?
Yeah, Chris is not hearing us, I don't think.
Can you all hear me okay?
Yes.
Yes,
Okay, good. Chris, I'm problems on your end. Yeah, I'm on. Well, here, just come in here. So Chris, we're going to do a audible. Chris is going to come in here and work off of this computer, and we'll get going here in just a few minutes. I think a few more folks we're expecting. Can you all hear me okay? Come in here. Work off of this computer, and we'll get going here in just a few more folks we're expecting.
JT, why are you standing up? You trying to be tall or something?
I got my stand at home desk on one of the many empty Amazon boxes that have come my way.
Yeah, good idea. I think I'm going to do that too.
It's the same stand-up desk I have in the office.
Guess mine's not tall. There we go.
Good afternoon, everyone. I think we've got a pretty good crowd, it looks like, on the call so far, so we'll go ahead and get started. 2020 for you. My computer's not working, so I'm in the same room with Mike. We're actually in the office, socially distanced, but if you can believe that. Anyway, thanks for everybody hopping on with us. We figured this might be a good time to get everybody on the horn. And as you guys are thinking about your commercial real estate loan portfolios in the Kansas City metro and regionally, we thought it might be a good time to bring up this subject of distressed loan sales and foreclosures, as we've found some good success in working with our Newmark partners on the East Coast. So on here with me, Chris Robertson, myself. I also have Mike Van Busker and TJ Wall. We sit here in Kansas City and focus our daily efforts on investment sales and capital markets, primarily in Kansas and Missouri, but also get up into Nebraska and Iowa and focus on acquisitions and dispositions of all asset types. And we're excited to have on the phone with us Brock Cannon, who leads our national loan sales efforts for Newmark, based in New York, along with Stephen Schultz and John Daniels, who we've worked on several projects here recently. And so with that, I think I'm going to kick it off to Mike to kind of give us an overview on what we're seeing here in the Kansas City market, and then touch on a few projects that we've worked on with our loan sales team. And then we'll dive into some of the distressed loan sales and foreclosures that our Newmark partners are working on and have recently transacted on here recently.
How's that for sliding in?
It felt like you were 6 feet apart too.
Oh, I was. I had a tape measure. Believe me, guys, I was 6 feet away from you. It's good to see a lot of friends on here today, and I look forward to the times that we can all get together in person and maybe have a drink and toast 2020 being behind us, and looking forward to 21. As Chris said, our practice here in Kansas City, we focus on all the property types, and that's historically what I always have done. And Chris and TJ have helped expand that, but that includes office, medical office, industrial, multifamily. We dive into quite a bit of development land as well, and retail assets. So we have experience in all of those that we can address, and we're leaving time at the end for questions and answers. So feel free to maybe send any questions to Chris through the connect here, or just raise your hand and feel free to raise it. When we partnered with Newmark 7, maybe 8 years ago now, one of the great things for us at the time being Zimmer Real Estate Services was that it opened up other business lines that we really never did before. And this is a prime example of it, was note sales. So working with Brock and his team, we've had some success in doing that over the years, including some transactions that we'll touch on this year as well. Chris, do you want to advance? Here's all of our pretty pictures. I'll highlight just a couple of things, and I'm going to have to pull this up because that's so small. Pull up this is the Kansas City investment sale overview. And one thing I'll mention to you all is if you don't receive our quarterly capital markets reports or other market reports we put out, maybe shoot an email to Chris after this, and we'll make sure that we get you on the list. But through Newmark, we put out a national capital markets report that covers all of the food groups that I mentioned earlier, as well as we do that for Kansas City and also for St. Louis, which is part of our territory. In addition, if you have any interest in specific asset types, drilled down to office, industrial, retail, and multifamily, we can do that as well and have those reports available. So that's something as a resource that I would encourage you to maybe take advantage of, because it provides a lot of market information that might be helpful as you're taking things to loan committees and doing your day-to-day operations. What you're seeing here on transaction volumes in Kansas City, broken out by the property types, as you would expect, the hottest property type has continued to be multifamily. I'm still shocked every day where TJ and Chris say, we know X and Y, Z, investor from Denver, from California, they're coming in from all over and chasing multifamily assets. Industrial has continued to be very strong and tracked right behind it as well. And literally there's new investors coming to Kansas City every day, chasing yield. They've got investment requirements they've got to meet. And Kansas City is on the radar screen. I will tell you, I've been doing this for 27 years, and 27 years ago, we weren't talking about investors coming to Kansas City. It was a big deal. We had one national investor, and it's a totally different market that we're seeing today. As you see here, market volumes are down, but transactions are being done. And some of those transactions were in the first quarter of this year, and we saw a lull of 2 or 3 months, or 2 months for sure. But there's a lot of transactions that are still being done in the COVID environment. And there's new product we're taking to market right now that we're hitting the ground in the first quarter. So we're expecting the first quarter of next year to be very strong. As far as one of the things Chris asked me about, I always talk about dry powder, but I think it's really important because there is a lot of money chasing real estate.
The last market report nationally we had was like $197 billion of funds set aside for real estate investments in all the property types. And so leverage that, your guys' mind, you know, there's 65% leverage on that. So that's, you know, $500+ billion of investment in real estate that is sitting on the sidelines ready to go. And we were seeing that pre-COVID, but it hasn't slowed down at all. And we're expecting to see it as we go into 21. Talk a little bit, Chris, once you advance to some transactions. These are just a few transactions that we thought we'd highlight that kind of hits on some of the things I mentioned earlier. Amazon Fulfillment Center. This is a prime example of money chasing industrial real estate. This was purchased by JDM Partners out of Arizona. As you see, the cap rate was in the 5s. You know, I never thought I'd see 5s in Kansas City on the cap rate. I learned to underwrite things at 10% cap. So just to put it in perspective, it shows how the real estate expectations, the yield expectations have changed in commercial real estate. In addition, Burns & McDonnell was another high profile. This is as you all know, Van Trust partners with Burns & McDonnell, or you should probably know, and built a new building. That was purchased by U.S. Realty Advisors. And this was the older building, which was owned by out-of-town investment family group. And they closed on that in a cap rate of 7.32%. And the last one we wanted to highlight here, Coach House Apartments. This was a property that was part of a larger portfolio, closed, and then very quickly flipped out the asset to another out-of-town group who now has a pretty substantial presence of Landmark Realty. So that was at almost a cap in 4s, in the low 5s. So those are some examples, I said, of what we're seeing. Those are the most active type groups, being industrial, single tenant assets, triple net assets, and multifamily. Following close behind that is groups chasing medical office, and that's continued to ramp up. I can tell you on our practice specifically, right now we have we're closing next week on an off-market transaction of a multi-tenant office building on College Boulevard. Our client's an out-of-town investor. This will be, I think, their 4th acquisition in Kansas City. Once again, private equity group chasing yield. We also have a medical office asset that we're taking to market to go over today. Suburban Johnson County Medical Office that we're selling. Just in this week, we've got multiple groups already signed confidentiality agreements, and expect that transaction will close in the first quarter of next year. On the multifamily side, TJ's has 2 assets under contract. One will close this month. We just took another larger portfolio out, large unit portfolio, and have multiple signed confidentiality agreements and people chasing that. So what we're seeing nationally, we're seeing here in Kansas City as well. And one other thing I will touch on, we are seeing land sales done in 2020. We had a couple transactions, very large transactions for development land. We've had some transactions that were actually REO property that we closed this year. And we're working on a couple of big ones that would be pretty exciting when we can announce them, hopefully in the first quarter of next year. So all property types at this point, we're still seeing good activity. So this kind of leads into the note sales. These are 2 transactions that we worked with our Newmark partners with. One of them is the Hammond's Tower, which if any of you from Southwest Missouri know is the largest building in Southwest Missouri. And it's also one of the most unique buildings because the floor plate for an office building is less than 10,000 feet. The anchor tenant in here used to be BKD, who's one of our clients. And they moved out of here a number of years ago. But anyway, we worked with our group to help in the sale of that, as well as Vatterott building here in Kansas City. This is north of Executive Park along 35. I'll let John maybe dive into more details on that. And then as we get into questions and answers, feel free to throw out any questions you guys have on the market as well. So John, I'm going to hand it off to you to take it from here.
Thank you, Mike. And then thank you, Chris. Thank you, TJ, our Midwest partners for setting this up. We'd also like to thank everybody who's here today, who took the time to take a break from calls and portfolio management and whatever it is you had going on to join us. So just to conclude on what Mike was saying relative to the loan sales we conducted in sort of the Kansas City or greater Kansas City market. The Hammonds Tower, that was for a special servicer. That was done last year. That was great execution. A little bit unique in that we had to run it through an auction, which is typical for special servicer sales, but similar to that, you know, and the Kansas City Valuations College deal, we love to loop in our local brokers, our product experts, both in Kansas City and nationally, because that allows us as loan sale advisors to tap into our national platform of buyers as well as their local relationships. Not only do we feel that it maximizes proceeds on pricing, but we also feel that when you are going through credit committee as a lender and you make the determination whether or not this is an appropriate haircut or price to transact at, that again, we got national coverage, that there were no stones unturned because we worked with our local groups. And more importantly, they give us credibility in terms of what the true value of this real estate is. One thing we do take pride in friendly competition. You know, we always try to bring the winning buyer to the table, and they're at a little bit of a disadvantage because typically the national buyers don't quite know as much as some of the local players, and I think that was evident on a vacant flex building such as Valuations College, where we actually exceeded pre-COVID pricing expectations by about 25%. Chris, if you want to take it to, I think, slide 9. Thank you. So here we are, and just a quick overview. Again, we focus as a team on loan sales, REO sales, UCC foreclosure sales. I'm going to let my colleagues Brock and Steven focus on UCC and REO sales today. I'm just going to touch on real quickly the loan sale market, as well as some relevant transactions that have occurred since March 20. I say post-COVID, but I guess we're still living in that environment. You can see here we've done about $400 million in closed transactions. We do take pride in marketing tradable paper. Part of that is being able to work with local offices such as Mike, Chris, and TJ, and again, getting to the collateral value. Beyond Kansas City, Newmark has offices nationally in every major market, every secondary market, many tertiary markets. And then we also have product specialists in some particularly sensitive asset classes who cover the entire country: hospitality, retail, specifically malls, senior housing, student housing. One thing I'd say to you beyond note sale advisory, and as Mike touched on at Newmark, we're happy to provide these services. We're happy to give you access to our resources. We have tons of calls with lenders, clients, portfolio managers who are just looking to get some color on either a particular asset or an asset class as a whole. So we're happy to facilitate those conversations. If you take a look at this slide, you'll see the first top left loan sale. It's a $45 million performing loan sale. This was done post-COVID. This was done for a CMBS lender, and this was done in the second quarter of 2020. COVID was very fresh. The CLO market had frozen up. I think pricing expectations were high on our end. Much of the market was skeptical that we would be able to achieve the price target that we set out to achieve. It was on a fractured condo deal in Queens, New York, and we got 99.2 cents on the dollar. Why is that important? We believe the structure we run, meaning a structured sale process with a firm bid date, the access to capital that we have, and the experience of our partners such as Brock, Steven, who have been through prior cycles. Those are factors that we believe contribute to our success in getting that pricing. Next to that example is the $63 million first mortgage on 1 million square feet of mall in just outside of Minneapolis. This was also a great transaction. The percentage of UPG wasn't quite in line with where the Allura transacted, but it shows our platform. We brought in Tom Dabrowski, who's the top mall broker in the country. We were able to collect over 200 confidentiality agreements, and we're able to sell a mall that had 3 or 4 vacant boxes and a ton of tenants who are filing for bankruptcy. So again, we rely on our resources such as Mike, Chris, our mall team, our hospitality team when we're marketing this stuff, and that gives us just another point of view as to how the market's viewing these things. I'm not going to touch on the bottom screen individually, but just wanted to real quickly gloss over those examples. Again, all post-COVID transactions, they range in size from $5 to $15 million in UPB. I would tell you there's a performing loan in there. There's a mezzanine loan. There's a couple non-performers, a couple different product type, including another mall, a CBD office tower in Pittsburgh. And these small to mid-sized transactions, from my point of view, have been the best execution post-COVID. You're getting signed loan sale agreements on the bid date. You're getting a non-refundable deposit the next day. And quite frankly, you don't have as much pressure from these buyers to go through a full credit committee where they may need a capital partner to write a check. And in today's uncertain environment, that's just a bit more challenging. And then real quickly, I'll touch on hospitality. Institutional, large hospitality note sales are a bit more challenging. Limited service, clearly the belle of the ball. We've got a $3.3 million limited service hospitality note in the middle of Pennsylvania. We've got unparalleled interest. Bids are next week, and we're optimistic that that's going to go well. The only thing I'd point out on the full service institutional hospitality, that trend that we've seen is borrowers clearly seem to be among the best resolution right now, but the structured sale process of a note sale, the pressure created through a note sale, forces them to step up and potentially, do something that they weren't otherwise willing to do before the pressure of third-party investors stepped in. So, Brock, Steven, I don't know if you have anything else to add on loan sales, but I was going to pass the torch to the head of our loan sale department, Brock Cannon. He's a UCC foreclosure expert, tons of loan and REO sale experience. So, Brock, feel free to take it away.
Can you guys hear me okay?
Yes.
Okay. How many folks are on this call that are in Kansas City? Is the majority of the audience in Kansas City?
I think that's, from what I'm looking at primarily. That's
Okay. So I'm going to divert away from this slide. This slide focuses on UCC foreclosure sales. But considering most of you are sitting in Kansas City, I'll give you a case study in your backyard there. UCC foreclosure sales, that's a mezzanine lender's right to pursue their remedies through the Uniform Commercial Code. Technically, it's a security. At Newmark, we have our securities license, and we're the #1 advisor in terms of conducting UCC foreclosure sales. #1 in terms of volume in the market, experience, et cetera, et cetera. We conducted the UCC foreclosure sale on the Mark Twain Tower right downtown Kansas City. And then once we successfully got through that process, we went on and sold the Mark Twain Tower. The client is a hedge fund in New York City named DW Partners. So we have experience right there in Kansas City conducting UCC foreclosure sales. To parlay onto what John Daniels was just talking about, another non-performing loan sale that we put in the market during COVID was, I believe it was a $37 million non-performing loan collateralized by a multifamily property in downtown Kansas City the property is called Pickwick. I believe it's more towards like the financial district, but that's a real-time non-performing loan sale that we had in the market right there in Kansas City. And something else that I wanted to note is that we are being hired to come out and sell the AT&T office tower, which is right in downtown St. Louis. And we should be coming out to the market with that probably the first half of January. So for those of you that might not be seeing our activity in Kansas City, while we're a national team, Steven, John, and I, most of our business is nationally. Maybe you could shoot us a note so we can add you to our investor list so that you're seeing these opportunities, specifically the AT&T tower, which we're coming out with early next year. That's all I really wanted to note, JD, is that we actually do quite a bit of business in Kansas City and would love to build the relationship, with everyone on the call. And I'm going to hand it off to Stephen Schultz, but thank you to everybody for taking the time today.
How you doing? Good afternoon, everybody. Steven Schultz. Been through about 3 cycles. You know, I'll talk about REO. Obviously, everybody know what REO is. We sold a bunch of REOs this year. It's going to be pretty relevant coming through this next cycle. I do believe we have a lot of regional community banks on this call. Correct me if I'm wrong, JD.
Yes.
So, you know, we've been doing a lot of valuation for regional community banks at this point, pricing both their loans and potential REO assets. So it's becoming very relevant to us to help those banks. You know, we're going to see a lot of REO, and having a national platform along with local expertise, we definitely can provide great valuation, great strategy to either keep it, sell it as a loan, or take it in an REO. So we have a few examples on our slides, but I'd definitely like to get closer to do the Q&A to see what any questions anybody has. But, you know, our national team is ready for this next, you know, cycle to hit. Obviously, we don't even think it's in the first inning. We are starting to do some values. We got a couple of loans in Missouri retail that we're starting to do. So I think we're going to potentially be a really good source for the banks at the local levels as well as the national level to help them through this next cycle. So, you know, that's all I really have to say as far as what we can help with. But I'd love to get the Q&A if we have any questions, which could create a great collaborative conversation.
Thanks, David. Don't see anything in the chat, so I'm going to kind of open it up for any questions in regards to the markets in Kansas City, the note sale process. I'll open it up for any questions anybody on the call has. Don't tell me we answered all the questions you could ever have.
So I'll start with something. What we have done as a team, obviously we have had transactions, and Brock explained that we do have some stuff coming to market and we are valuing. You know, the biggest thing we're doing with banks and institutions is advising. Transactions will come. So again, if you have any loans or /REO or potential REO that you have in your portfolio, we want to advise and help you price. We have local expertise. We also have a loan sale technology tool we do to help price and give guidance accordingly. Obviously, regulations might tighten with the new regime. Who knows how that's going to work? I know banks are under pressure, potentially pressured for loan loss reserves and account scores and capital. So we're here to help, and I think we could be a real value add for any lending institution to help them with their strategy of their portfolios. Just
to piggyback on that real quick. Again, wanted to make sure we were efficient with our message today. We do a lot of work with the FDIC. Have closed a few banks in Kansas over the years. Fortunately, none of your names have ever showed up on the list. But to Stephen's point, we're very familiar with bank portfolios. Obviously, we focus on commercial real estate, but we have experience, tons of experience. Over 200 banks we've closed. You know, 200 billion in valuations. So, you know, we do spend a lot of time having these conversations and taking a deeper look at portfolios and helping you navigate sort of some potential challenges down the road.
Seeing questions pop up. Let's get busy. Let's go.
Yeah, so this first one is, when do we determine the best time to start the process of a loan sale as opposed to the bank holding the asset and continuing to work out of the loan? John, do you want to maybe take that one?
I'll do it.
Or Stephen, I'm sorry, go ahead.
No problem. I think now is the time to start, you know, strategizing on value and valuation. You know, again, I've been through 3 of these cycles, and I believe, it hasn't even started yet. So to get in early and understand where your loan is and asset is important. Obviously, Michael, you're saying that stuff's trading now, but as it gets deeper into the potential destruction, you know, prices will plummet, and then it will come back up again. So I think we're all advising on our team, whatever kind of loan you have that could be in potential trouble or or tarnished or every which way, is to start pricing now and start creating collateral value now.
I would echo that. Stay proactive now. I remember 2008, 9, 10, the banks that moved quickly and that were proactive and they were able to take losses. I mean, the private bank out of Chicago, a regional bank, the banks that moved quick, they survived. Those that kicked the can down the road, those that just gave their distress loans to an asset manager to kind of see if there were current clients that wanted, those banks were getting shut down every Friday. I remember it vividly. Those that moved the quickest got out of it. A lot of those that moved slowly and thought they could figure it out on their own, they shut down.
Yeah, I think right now, I think our team has over $1 billion in valuation. They're not in transaction mode yet, but every bank we're telling, let's be proactive. We just got a $30 million small balance portfolio we're selling. We're picking up pretty dramatically. So stay ahead of it, especially with all the investor money that's out there. And pricing is going to be better now until it craters, and it's going to take a while to come back up. So that's what we're advising.
Next question here, doing valuations for retail, what other sectors do you anticipate experiencing high levels of default? I'll jump in just quickly from what we're seeing in Kansas City, and we do a lot of broker opinion of values, BOVs, for clients, including lending institutions, as you all know. And I can tell you right now, what I'm seeing is requests on the hotel space quite a bit, and then we are looking at some potential development land as well, and then a few office buildings that we're being asked to look at. Guys, Stephen or John or Brock, you want to comment on that one? What you're seeing?
Go ahead, Stephen.
Yeah, listen, I think every other than industrial, maybe self-storage, is going to have some kind of, cracking. So obviously hotel, retail, certain office, but we're seeing a lot more hotel and retail right now. Obviously, you're not in Manhattan, but Manhattan's just getting crushed all the way around. So, we're going to see a lot of different cracks in different areas, but I think industrial and self-storage is pretty bulletproof right now. I don't know, Brock, if there's another product type that you're seeing that is going to be safe.
I mean, I'd say multifamily has performed well, but me personally, I live in Bethesda, Maryland, just outside of DC, and there's certainly an exodus from the city. The only difference there with these, Class A multifamily developments, and I would say is probably something you all should take a deep look at within your portfolios, is sponsorship. For sponsorship becomes so important for those that can weather the storm, that maybe we're a bit more conservative on the underwriting or that have cash on the balance sheet. That's critical at this point in time. A lot of the stuff, to Stephen and Brock's point, that we're working on today, that we're in the market with right now, they didn't have great sponsors, so they couldn't quite get through this rough patch. And I think, the question is, which is why it's important to get ahead of, your challenges, is how long is this going to last? How long is this going to last?
Sponsorship is very important.
Another interesting thing that everybody in this call should be aware of is the eviction process. Obviously, the government saying no one has to pay. It doesn't really apply to commercial, but there are commercial tenants saying we don't have to pay, evict us. And what that does, it affects resolution periods on if you want to sell, so it hurts pricing. And that's going to take a while. Courts aren't even hearing eviction cases right now. So there's a lot of moving parts that will cause value depletion, and that's why we're advising, let's stay ahead of it now and be proactive.
Stephen, the next question here, what sectors of CRE are you seeing concentrations of interest from sellers of notes? You want to take that one?
It's all around the hoop. I mean, wherever there's opportunity. Like you said, how much investor investor money's out there. So they're all so focusing on the opportunity. I don't think it's really product oriented. Obviously, there's people that's focusing on hotel, focusing on retail, repurposing, vacant office. So it's all over the map.
Next question, are we seeing an uptick in foreclosures in the KC market? What sector of the market most at risk? Touched on this a little bit already, but from our perspective, as I said, hotels and motels are the ones we're looking at quite a bit, with a few office buildings in certain sectors, certain parts of our submarkets that we're seeing some potential exposure in. And I think John hit on a few things. I hit on something earlier on the multifamily. The multifamily space has been so dynamic here. If we see any softening of that, that's why the sponsorship is so important, especially on new construction product that's coming on and needs to go through the lease-up process or even renovation. There is some potential exposure in certain submarkets that I would be a little concerned about. Are CMBS special servicers extending loans on hospitality and retail due to difficulty in refinancing? Brock, Steven, or John, you want to take that one?
Yeah, Brock.
Yeah, the special servicers negotiated forbearance agreements across the board for hospitality borrowers and retail borrowers. Sounds like the borrowers proposed 18-month forbearance agreements. Lenders came back with 3 months, or servicers came back with 3 months. And then I think the average forbearance agreement that was put in place in June was a 6-month forbearance agreement, which means those are probably burning off before we go into the new year. It'll be interesting to see if they extend the forbearance agreements and for what in return, a la, is the borrower required to provide a lump sum payment, put more equity into the deal, et cetera, et cetera. The special servicers, in my opinion, will be very active sellers starting next summer, and they'll be selling CMBS 1.0, the CMBS 1.0 vintage deals. Those would be loan originations from back in 2006 and 2007. Yes, we're still working on distress from 13 years ago, which means the distress that's coming out of this pandemic, we're going to be working on this for years and years and years to come. Special servicers are a main focus of ours. We're probably their top advisor at the end of the day, between CW Capital, L&R, Midland, who's in your backyard, C3, who's now Greystone. They've been very patient with the borrowers at the direction of the bondholders, but we think next summer they're going to become very, very, busy sellers.
And what's cool about our team is we cover the whole lending world, and regional community banks are a big part of our business. So again, servicers, regional community banks, debt funds, mortgage REITs. We have a big team to help in any which way. But the services are going to be a big flood, and that again goes to pricing. Why wait? If you can sell, why wait? Because there's going to be a flood, and it will, pricing will change.
I should note the AT&T sale that we're coming out with, AT&T building, downtown St. Louis, largest building in the state of Missouri. That's for a special servicer.
Okay, any other questions from anybody on the call?
One of the things the banks maybe should consider as they're trying to find ways to do business in this current climate, other than originating for relationships or doing origination, is potential note-to-note financing. We'd like to work with banks that potentially have the capability to do note-to-note financing, not maybe on their loans, but others. And we have closed a few deals with lenders doing note. It helps drive pricing. Brock, you want to maybe explain that one deal that we did?
Yeah, we helped a buyer, Harrison Street out of Chicago, was buying a note collateralized by medical office down in Phoenix, Arizona. And we worked with Thoroughfare Capital out of Los Angeles to provide note-on-note financing. which at the end of the day enabled the buyer to push their pricing and make them stand out from the rest of the pack. I would tell you, it seems that could be an open market. There might only be 6 to 8 players out there who are truly financing notes. It's something that if I was a lender, I would definitely be looking into. I would tell you the terms are like 50% leverage on the note on the acquisition price. So those that are doing note on note financing feel very comfortable in their position. And also keep in mind that they feel comfortable taking over the collateral, worst case scenario. So I think that's an open market for those that want to think outside of the box and start originating some financings, on paper versus the asset or the hard assets.
Yeah, in our Pittsburgh sale that's noted on one of the slides, the buyer did get 50% note financing from a relationship bank out of New York, and it was in Pittsburgh. So it's just I just wanted to throw that out. If there's lenders out on the call that might want to find different ways to create opportunity.
And then just real quick to piggyback, I think one common misconception, that's tied to note sales is distress. As I mentioned with the Allura, we sell performing loans. It's a great portfolio management tool, particularly after an acquisition or a merger. So, as you guys take a look at your portfolios, you may not have to look for what's in special assets already. If you have an overexposure to a particular relationship that's of concern, or within a specific market or submarket, or of a certain product type, that's where we're sort of trying to be strategic, culling through these portfolios and maybe identifying some subsets of loans that we could trade at par or a premium, depending on the loan traits. We just sold a loan at 102 cents on the dollar. So I think those are things to think about as well as you sort of take away some of the points we've given you today. How loan sales can be a tool, a portfolio management tool.
Great point, John. The slides that we had today, we will send to all participants via email. And I want to thank Brock and Stephen and John for doing this with us today, and I thank all of you for joining. Any last questions from anybody, or the points anybody wants to bring up? Great. As I said earlier, I see a lot of folks on this call that I look forward to maybe toasting sometime and having a drink in the first quarter and seeing you all face to face again. So thank you very much for doing this.
Brock, Ned Smith's on the call. How come he didn't ask a question yet?
He's texting me questions. He's hiding.
We want to hear the question, Ned. Come on, let's hear your voice, Ned.
Hey guys, good to see you. I'll vouch for every one of these guys on the call. They're all good guys.
like the beer, Ned.
That's what you get when you work at home.
Who's Ned? Hey,
Let me know when you guys are in town.
I'll leave everyone with the final note. I was on a public call yesterday with folks on the West Coast, out in Los Angeles and throughout California. And these investors were talking about as we're coming out of this pandemic, as we're coming out of these distressed times. And then they're also talking about liquidity. And for those of us that are in commercial real estate, I think Stephen Schultz touched on this earlier. We just started batting practice. This game hasn't even started. If you recall, Lehman Brothers filed bankruptcy in September 2008. The loan sales market didn't really heat up with large portfolios until 2010. So there's some lag time. I think the first inning starts next summer. I really do. And then they asked about liquidity. These lenders, the lenders that have these loans on office buildings in New York City and condo developments in these major markets, Miami, Seattle, Chicago, New York, LA, whatever, they are about to take astronomical losses, larger than 2008, 2009, 2000. I'm in New York. I see it every day. So I don't know where the liquidity is going to come from, but the feds know how much trouble we're in. A la PPP money. I can't tell you how many people I know got $25,000 checks forgiven. They don't even have to pay it back. And the stimulus money. So just as a heads up, commercial real estate folks, this game's just getting started. and lenders are about to take astronomical losses in these big markets. So I'm not exactly sure where the liquidity is going to come from, but I appreciate everyone's time. I look forward to keeping up the dialogue.
Sure.
Thank you all. If there's anything we do for anybody on the call, feel free to reach out. You'll have all of our contact info, and appreciate everybody taking the time.
Thanks, everyone. Have a great holiday.
Thanks, everyone.
Happy holidays.
Thanks, Mike and Chris, for setting up.
Talk to you soon.
There you heard it, folks. Hopefully you followed along in some of those comments as well. But the opportunity for distressed properties, it sounds like from a commercial standpoint, we know there's going to be some significant distressed foreclosed properties. That last comment there was very telling by Ned, stating, you know, some of these commercial banks and lenders are going to take on astronomical losses, which means they're going to be trying to offload some of those properties. So great opportunities to, you know, if you're a realtor, you know, to start stealing some of your clients in that area. You know, if you're an investor, to start looking in those areas, because, you know, with COVID and all these businesses being either shut down or limited or socially distanced or reduction of space, you know, there's going to be a glutton of commercial property, multifamily properties that are going to be out there and going to be available, you know, and the early bird gets the worm, you know, the early bird gets the worm. So, you know, I thought this would be very interesting, you know, for myself to attend this, because, you know, understand opportunities create opportunities. And unfortunately, sometimes those opportunities don't, bear with me one second, guys. All right. Sometimes those opportunities are not always the ones that we would think would be the best of circumstances, but, you know, depending on what business you're in, it is what it is. If you're in real estate, from an investment standpoint, from a realtor perspective, understand that this market we're in, there's opportunities that are out there. You saw them talk about Amazon buying fulfillment centers. If you haven't seen what Facebook is doing in markets like New York, Facebook is gobbling up office space, and that is a significant amount of office space that's on the market. You know, look at the New York market and look at Manhattan and look at all those buildings. Facebook and some other companies are gobbling up office space. What do they know? What are they acting on that maybe we should? You know, while the smaller guys are going out of business, the bigger guys are gobbling up that space. Buffett talks about he buys when there's blood in the street. So, you know, hey, listen, you're an investor, you work with investors from a real estate perspective, understand this is an opportunity. There's some things out there. So hopefully you enjoyed it. Drop a comment, like, and share. We'll be back on Friday as well for follow-up Friday at 9 a.m. with Carlos Savalos. Take care. Let me know if you have questions, guys. Sanitize up. Have a good day. See ya.